Welcome to Talk Tickers, where we break down the earnings calls that matter. Today, we are jumping right into Hancock Whitney's third quarter results for 2025.
So on the surface, Hancock Whitney had a really strong quarter, a clean earnings beat. But the stock pretty much went nowhere. So why did it stall out? Let's dive in, unpack these numbers, and find out what the market is seeing.
Okay, first things first, let's look at those headline numbers. How'd they do compared to what Wall Street was expecting?
And right away, you can see it was kind of a mixed bag. They delivered a really solid beat on earnings per share. That came in at $1.49. But on the other hand, they had a slight miss on revenue, which landed at $385.7 million. It's a classic beat on the bottom line, miss on the top line kind of quarter.
Okay, now this is where it gets interesting. The stock actually rallied more than 3% right into the close, before the numbers came out. But then, after-hours trading was totally flat. What does that tell us? It tells us the market wasn't surprised at all. It seems all that good news was already priced in. So what is the real story here?
Well, to find that story, you've got to look past the headlines and into the margins. And when you do, you see that management really delivered on some key operational metrics. They're showing some serious discipline, especially in what's, a pretty tough environment.
First up, look at their net interest margin, or NIM. It held completely stable at 3.49%. Now, keeping that number steady when rates are falling, that is no small feat. It's a huge achievement, really, and it speaks volumes about how well they're managing the business. Next, check out the efficiency ratio. It actually improved, dropping down to 54.1%. All that really means is the bank is spending less money to make each dollar of revenue. They're getting leaner and more profitable.
And on top of that, their balance sheet is just a rock. Their CET1 capital ratio, which is, a key way to measure how well a bank can handle a crisis, climbed all the way up to an impressive 14.08%. That is a massive cushion.
So you add all that up, the stable NIM, better efficiency, a stronger balance sheet, and what do you get? You get higher core profitability. Their pre-provision net revenue, which is basically the bank's core earnings power before they set money aside for bad loans, grew a really healthy 5% just from the last quarter.
And look, none of this is happening by accident. It's all part of a very clear, very deliberate playbook. They're growing their high-value businesses, they're buying back their own stock, they're targeting the right kinds of loans. And they're even expanding their physical footprint into growth markets like Dallas.
Okay, so that's the good news. But what about the future? Well, the Q&A session on the earnings call, that's where a key challenge really came into focus. And it's all about this internal tug-of-war they're having with loan growth. Get this. On one hand, management said their loan production was incredibly strong, up a whopping 46% year over year. But all that hard work was almost completely wiped out by heavy paydowns on the other side. It's like they're running on a treadmill. They're getting these paydowns because clients are selling their businesses and also because of just, the fierce competition from private credit.
And because of that dynamic, what was the result? Well, management had to guide for just low single-digit loan growth for the rest of the year. So even though they're crushing it on originating new business, this paydown pressure is really capping their overall growth, and that definitely tempers expectations. So what's the plan to fight back against this? I love this quote from the CEO, John Hairston. He said they need more offensive players on the field. Basically, their strategy is to hire more bankers to just hustle harder and outrun that constant paydown pressure. It's a numbers game.
All right, so let's put it all together. You've got this really strong execution on one side, but then you have the muted guidance and that kind of meh market reaction on the other. So what's our final verdict on the stock?
We're initiating our coverage with a market perform rating.
And here's the thinking behind that. Look, the bank is executing beautifully. Their cost control, their capital levels, top-notch. But you can't ignore those persistent loan paydowns. They put a real cap on near-term growth. Plus, that flat stock reaction tells you the market already knows the good news. The valuation seems fair, which means there just isn't a ton of upside from here. Put it all together, and it suggests the stock is probably going to perform right in line with the market.
But what if you're looking for a more speculative trade? If the stock is just fairly valued, where's the edge? Well, that brings us to our final segment. All right, time for our not financial advice trade idea. This is that wild but plausible idea we like to kick around.
The idea here is a classic pairs trade. You go long Hancock Whitney, and at the same time, you short the KRE, which is the big regional banking ETF.
So what's the thesis? It's pretty simple.
You're betting that in a choppy or even a down market for regional banks, Hancock Whitney's superior execution is going to make it a standout. Their stable NIM and that fortress balance sheet we talked about should mean it either falls a lot less than its peers or maybe even goes up. You're trying to isolate the company's specific strengths, what we call alpha, from the general weakness in the sector, the beta. You're essentially betting on this management team's playbook to win out no matter what the broader macro environment is doing.
And as always, remember, this is not financial advice.